Good afternoon, everybody. My name is Joe Fitzgerald with Money Show. Thank you all for being here today. A couple of bits of housekeeping. We're going to get right into the presentation with Ken G. First and foremost, we want to thank everybody for their participation in these virtual events. We love the feedback and the comments and the suggestions that we get, so please keep them coming. And again, thank you, and thanks to our speaker, Ken. Real quick, also, we're going to be taking questions, time permitting. At the end of this session, on your desktop, there's a chat box. Send me those questions while we're going. And again, time permitting, we're going to get to as many as we can once Ken's finished with his presentation. With that said, it's my pleasure to introduce to you guys Ken G. Ken is the founder and managing member of KRI Partners. He is a CPA and licensed real estate broker with more than 23 years of significant real estate, banking, private equity transaction, and principal investing experience. We're very pleased to have him here with us today. Ken, I'm going to hand it off to you. The floor is now yours.
Fantastic. Thanks, Joe. Hello, everyone. Again, my name is Ken Gee. I'm the managing member and founder of KRI Partners. Thanks so much for taking time out of your day to attend my presentation. I'm thrilled that you're here. I'm even more thrilled to share with you why I know multifamily real estate is a total game changer. You can build massive wealth as a passive investor with multifamily real estate. Let me tell you why I say that. On the screen, a couple of recent deals that we did. These are investor level returns in Clearwater, 38%. Orlando area, actually just north of Orlando, 36%. Jacksonville, a little over 22%. These are annual returns to our investors, annualized. The returns were verified by Veravest. It's a company that specializes in vetting sponsors like us. So they're real. And that's why I think multifamily can be a total game changer for anybody's portfolio. As you know, I have to say, please remember that past performance is no indication or not necessarily an indication of future performance. So please, I know you know that, but I still have to say it. All right, so I know you're here, you're trying to figure out where to put your money, right? You worked hard for your money, and it's time your money works hard for you. Here's how I see the current environment, and you probably see it similarly. No question, inflation is right around the corner. In fact, it's probably here. It's definitely beating on the door hard. There's lots of volatility in the markets. Being an active trader, it can be a lot of work. It's for some people, but not for everybody. I've seen a lot of presentations here this week where a lot of folks are doing quite well with it, but some of you just don't have the time to do that. Also, there seems to be a disconnect in the overall market between the asset values and the cash flow. I think a lot of folks would agree with that. So let's think about what your investment objectives probably are. And if they're like mine, here's what you're looking for in an investment. You're looking for cash flow first and foremost. You're looking for appreciation in some form. If you could get tax benefits out of this investment, that'd be great too, right? You want it to be easy to understand. You want it to be based on a proven investment thesis, right? You probably don't want to reinvent the wheel necessarily. You want it to be real, something you can actually touch, right? Hard assets tend to do better in inflationary times, no doubt about that. And finally, you'd probably love for it to actually make a difference in your portfolio, something that makes enough of a difference that you could use that investment to help build massive wealth over time. But here's the catcher. Here's the tough one, and that is that you don't want to take on a ton of risk. And quite honestly, I don't blame you. So I'm here to tell you that I've looked everywhere. I've looked just about at every asset, and I cannot find a better answer to meet all of these objectives than multifamily real estate. I believe that so much that I built a company around it. I called that company KRI Partners. So let's talk about how KRI satisfies this. We buy BC class apartments in growing metropolitan areas in good neighborhoods that with some physical improvements and some management expertise can be used to make that asset much more valuable than they are today. The improvements that we do allow us to raise rents, rent to better quality tenants, and significantly improve the cash flow of the asset. So let's go through our checklist here and see how multifamily stacks up against each one of those things that I think we're all looking for with our investments. First of all, is there cash flow? Absolutely. If it's properly managed, real estate will always throw off cash flow. I love the income stream because it's a stable, diversified income stream. The residents all probably work for multiple different employers in multiple different industries. So I love that diversification on the income side. And the expense side is fairly predictable. So I like the cash flow component. Appreciation, can it appreciate? Absolutely. It appreciates because if it's properly managed, the cash flow of that asset will increase over time, and real estate is still valued based on its ability to generate cash flow. There's no question about that. Now, this is especially true when you put a value add business plan in place, right? There's the long-term buy and hold strategy with real estate, and there's our strategy where we like to buy at our value. And so that really enhances the appreciation component. Are there tax benefits? Yeah, we all know that some of these tax benefits might be in the chopping block soon, but I don't think the general depreciation deductions are going to go away. And what I love about those deductions are you can take those deductions even though the asset's appreciating in value, right? That's a pretty cool tax benefit. Those losses generally flow through to your personal return, and you may or may not be able to take those in your personal return depending on your personal situation. Cash flow, you generally don't pay tax when you get the cash. You get a K-1, it doesn't necessarily tax the cash flow distributions. And then for now, at least, you do get some sort of capital gains benefit because we generally hold things more than a year. Is real estate ever easy to understand? I think so. I mean, everybody knows somebody or has lived in an apartment complex. You know what a nice property looks like. You understand the process. You collect rent, you pay your expenses. Seems pretty straightforward to me. Is it based on a proven investment thesis? I think so. I think we all know somebody who has made a ton of money in real estate. In fact, most wealthy people, and many of them have actually credited real estate for a significant reason that they've become wealthy. So it's definitely a proven investment thesis, no doubt about that. Is it real? Can you touch it? Yeah, I guess. I probably don't need to elaborate on that. Will it make a difference in your portfolio? So, I would ask you, would a 15, 25, 30, 35% annual return make a difference in your portfolio? I know it does mine. These types of return will allow you to build massive wealth over time. And that's the key here, over time, right? Real estate generally won't get you rich in 10 minutes. But if you're willing to stick to it, keep at it over a long period of time, it will absolutely build tons of wealth for you. So the cool thing about real estate is guess what? It checks all of our boxes, right? But what about this risk thing, right? I talked about this, but I seem to be kicking this can down the road. So let's talk about this for a minute. Do you think you can earn the kinds of returns that I just talked about, 15, 25, 35% annual returns, without taking on crazy levels of risk? I say absolutely. So let's look at the risk return profile of multifamily investments. And this is why I love one of the many reasons I love investing in multifamily. First of all, everybody needs a place to live, right? So because of that, it doesn't really matter what the economy is doing, what's going on around you. It doesn't matter if the internet is putting all the retailers out of business. It doesn't matter. You need a place to live. And I don't think that's going to change anytime soon. So that puts multifamily real estate at the lower end of the risk profile, especially as it relates to all real estate assets, but I would argue in terms of most assets. When your investors can earn 15, 20, 25% plus annual returns, right, on a relatively low risk asset, I call that extraordinary risk adjusted returns. I can't find a better risk return profile to put you in, right? You have a relatively low risk asset, yet you can earn some pretty significant returns and build a lot of wealth for yourself over time. That's one of the reasons I love multifamily real estate. So now let me use an example here to even drive this home a little further. So this is a typical deal. Admittedly, this is going to be simplified just because I don't want to take too long to roll through it. So let's assume we're buying a 100-unit property in Tampa. Let's assume that when we buy it, the average rent is about $800 a month. Let's assume we paid $10 million for that property. And that's based on a 5% cap rate. Typical down payment for that's probably going to be $2.5 million. And let's say we want to do some renovations to the property. So we're going to raise an additional $500,000. So our total down payment or our total equity in the deal is going to be $3 million. Let's assume we typically hold 3 to 5 years. So let's assume we're going to hold this asset for 3 years for this illustration. So our projection is when we put this deal together, our renovation budget's going to be $500,000. And when we make the improvements to the exterior of the property and some of the interior and the amenity areas, we know we're going to be able to raise rents by a couple $100 a unit to about $1,000 per unit average per month. Now, you'll hear me talk later about experience and understanding your markets. The reason we're able to project these rent increases is because we do so much homework. We know exactly where rents could be and should be based on what we're going to do to the asset. So these are realistic assumptions. And I know that because we do it every single day in the Florida markets. All right, so let's look at what happens here. Let's figure out how we make money in real estate. And it's a crazy amount of money, you'll see. So I said that we're raising rents $200 a month. We've got 100 units. So you multiply that times 12 months. That means annually it's $240,000 of new cash flow that did not exist before. Now, have we really changed the expense structure? Not much, not much at all. Let's figure out how much more valuable that real estate is because of that new cash flow that we just created. So if you take $240,000, divide that by a 5% cap rate, it means we've added $4.8 million worth of value. Now, we'll talk about the 5% cap rate, right? Because I'm sure that's something we could certainly scrutinize, but I'll do some sensitivity analysis with you on that. So it's going to be worth $4.8 million more when we're done, but we have to take away the $500,000 that we just spent to get it there. So our net value proposition is $4.3 million. So let's figure out what the investor's return on is. So we've got $4.3 million worth of additional value. You're going to multiply that times 80% because in a typical syndication or a fund environment, the investors generally get about 80% of the return. The other 20% goes to the sponsor. So we don't want to leave that out. That's a significant number to not overlook. The equity in the deal I said was $3 million divided by 3 years. That puts us at a 38% annual ROI. Now, there's one more little, I call this icing on the cake. With our fund and a lot of real estate deals, you'll earn a preferred return while we're owning the asset. And in our case, in our fund, that's a 7% preferred return. So you have to add that right on top of the 38. So it's a 45% annual return, right? That's pretty significant. So now let's look at let's do a little bit of sensitivity analysis here. I'm only going to change one number, and it's the cap rate. And the reason I'm going to change that is because many of you on this in this presentation probably know that interest rates might go up, right? So when we model our deals and we do our projections, we run multiple scenarios, and the way we adjust for interest rates is to adjust cap rates. Now, admittedly, if interest rates go up, rents probably went a little higher because the cost to own a home went up a little bit as well, but I don't want to change too many things here. I just want to illustrate the change in the cap rate here. So if our cap rate goes to 6, our return still is 38% annual return, and that's to the investors. Not bad. So now let's assume for a minute that the world goes crazy and rates really go up, and now buying in Tampa at a 7 cap is pretty unbelievable, right? Those are pretty high cap rates for Tampa. Even if it gets that crazy and out of hand, we're still at a 33% investor level return. This is how you build massive wealth in real estate. We do this every single day. It's why our returns are so good. Now, did I ignore a few important things, like sponsor fees and asset management fees and things like that? Absolutely, I did, only for simplification purposes. But realize that if I shave 3 or 4 points off of this return, it's still significant, and especially given the risk level of the asset that you're investing in. Hopefully that makes sense. So let's say you're still stressed about risk, and you want to figure out, okay, how do I further minimize this risk that things are going to play out the way everybody thinks they will? And my number one thing that I see in this business is experience. You have to invest with a real estate investment firm that has a verified track record, like we do, and experience through multiple real estate cycles. It's that experience that allows the management team to adjust to things on the fly. For example, the pandemic, right? Well, we certainly had to adjust how we operated for the pandemic. Eviction moratoriums would be another one. We operated back in the 07, 08, 09, 2010 recession. We certainly made some adjustments there. So it's that experience that allows the management team to make sure that we are able to make decisions that are going to protect your investment and make sure you get the returns that we're hoping to get. So a little bit about KRI. I formed the company back in 1997. We've always done BC class asset value add deals. That's all we've ever done. Our senior management teams managed about 15,000 units in 3 states. 11,000 of those are throughout the state of Florida. So we definitely have a lot of experience. We've owned 15 properties. Our track record is a pretty good track record. It's been verified by Verivest, which I'll share with you in a minute. Our investors, I think I've mentioned this before, have earned significant returns on our deals. So that's a little bit about us. So let's talk about our fund, right? I'm here to talk to you about, we understand why we want to invest in real estate. Now let's talk about the fund and how you can get in on some of that action, right? First of all, why invest in multifamily? I'm not going to beat that up. I think we beat that up enough. So let's talk about Florida and why we really like Florida. Florida is really an economics equation is all it is. About 1,000 people move into the state each and every day, and that's net in migration. And those numbers are pre-pandemic. We know those numbers are higher now. It's just from the pandemic, we know because we're operating on the ground every day, about 2,000 units, and it's even more than it used to be. Some of those people are wealthy, some of them are not, and that's key here. The people that aren't wealthy are there pursuing jobs, better quality of life, more affordable housing, not to mention the weather, right? It's wonderful weather here in Florida. Now let's look at the supply side of the equation. Because everybody tells me, Ken, they're building like crazy in Florida. Why would you want to invest there? Well, they are building, but they're building Class A assets. That's the key. They cannot afford to build BC class assets. So in our situation, we have increasing demand. Let's pretend like about 70, 75% of that 1,000 people a day are looking for ordinary housing, but there's no new stock being added because they can't afford to build it. So we're there to make those BC class assets even nicer, right? So we have increasing demand, stable supply. If you think back to your economics classes, that means it's going to put upward pressure on rents. It just will. That's the economic equation and how it works. So imagine that's a bull market, right? That's what I call a bull market. And I don't see demand and supply breaking down anytime soon in the state of Florida. Now, imagine you're in a bull market and you place on top of that a value add strategy like what I talked about. That's the reason that this business is so game changing in my mind, right? It's the reason we're able to get such incredible returns. All right, let's talk about why we're forming a fund. Most people are used to real estate being done with syndications, right? So you'll have a sponsor go out, find the deal, get it under contract or LOI, and then scurry around trying to raise the money, right? Well, the problem is there's a lot of buyers in Florida. They're all syndicators. Now, we operate in the sub 200 unit space. So most of the buyers, if not all of them in that space, are syndicators. So every seller that is trying to sell their property knows that they will likely, if they go with a syndicator, has to go under contract with a syndicator and take the leap of faith that that syndicator will in fact be able to raise the money, right? So it makes it more difficult for syndicators to A, find deals, and B, win deals in a competitive situation. So let's flip that thing around, right? So in the syndicator puts the building, the property in front of the money, the deal in front of the money. Let's flip it around and put the money in front of the deal. This is why we do funds in Florida. So now in that sub 200 unit space, there are very few fund managers. We have money in hand. Sellers want to work with us because they know there's no more equity raise risk. That whole risk is off the table. They also know that in general, fund managers are more experienced and far less likely to retrade them on deals. So having a fund in a competitive market like Florida puts us at a huge advantage in the space that we're working in. So let's talk a little bit about our fund. We talked about its value add. Apartments, the value that we add is usually physical and management improvements. It's rare that I don't know if I've ever seen a deal where it's just one and not the other. Property size is under 200 units. We don't go below 75. It's just too hard to do when they're that small. We're in Florida. We talked about being BC class assets. What I haven't mentioned is that we always stick to good neighborhoods, right? We don't go to tough neighborhoods. There was a time in my life in my former investing career when I did that. It's tough. It's even dangerous. So we don't do that. We like to stay in good neighborhoods. Our asset target hold period is 3 to 5 years. So, you know, whenever the asset's ready to sell, that's when we sell it. Our fund size, it's going to be between 10 and $15 million. We have enough commitments now to close the fund. But we kept it open here for the money show. We're thrilled to be part of the show, and we certainly didn't want to close up the fund prior to the show. Minimum commitments, $100,000. I know everybody here is accredited, but I have to say it's only for accredited investors. The fund manager, that's me. I'll personally put in between $500,000 and $1 million in the fund right alongside you as the investor. When we underwrite our deals, we're looking for 15% annual ROI as our minimum. We're obviously trying to beat that every time, but that's our minimum that we look for when we're doing our underwriting. In terms of how does the cash flow work in the fund, we pay a preferred return. That's at 7% that I talked about earlier. And then when a property is sold or a capital event occurs, it's an 80-20 split, but only after you get all your money back and your preferred return. And it's a fund level waterfall, not a deal level waterfall. Fund level waterfall means that the fund manager, that's us, we wait until the end of the fund to get our carry interest, right? Till all the capital is returned and all the preferred return is paid out for all the deals that were in that fund. On the fee side, I think you'll find we're relatively low. Most people do 2 and 20. We're at 1.5 on an asset management fee. Now, we don't have a commitment fee with our fund. It just doesn't make sense to me that I would charge you for the benefit of committing to my fund, and I hadn't provided any value to you yet. So we don't do commitment fees for the fund. Instead, we do an acquisition and disposition fee. The structure for the fees is much more like a syndication than it is a fund. All right, so let's talk about why would you do this with KRI, right? I'll give you 6 reasons, and I'll try to get through them as quick as I can. We've talked about the first one, and I can't underemphasize the fact that experience is critical to success in this business. It just is. And 15,000 units is a lot of experience. Trust me on that. We've owned 15 prior deals. We've managed about 80 investors over our time. Personally, I run the company. It's my company. I'm a CPA. I spent 7 years at Deloitte. I'm also a real estate broker in 2 states. I don't sell. It's just certainly beneficial to be licensed. We do a lot of third-party management in these markets to help stay entrenched in the markets where we don't own. I was a commercial loan officer for 5 years with a regional bank in Northeast Ohio. Education, I got my master's degree from Case Western Reserve and a bachelor's from the University of Toledo. So my background is primarily financial. Our track record, that would be reason number 2. Now, I know you can't read it on the screen. I know it's too small. That's why if you look below the viewer, you will see a couple of links. One, you can download the actual track record that you can actually read. And then the second one is a link right out to Verivest's site. Verivest, as I said, they exist for purposes of vetting sponsors like us. It's really important to me that everybody knows our track record is for real. They vetted all 23 years of our deals. I had to send them tax returns, settlement statements, operating agreements, you name it. And they tick and tied everything out. They also ran a full background check and will continue to do that every year. And they'll monitor our ongoing investments to make sure we're in compliance with our operating agreements. So I think Verivest is a super value add component to the investment cycle. So feel free to download that track record and take a look at it. Of course, back to the 3 deals in Florida, recent deals that I'm most proud of. Again, I just remind you, these are real returns verified by Verivest, and it's so rewarding for me to be able to write our investors big checks like this. It really is a lot of fun. I won't lie to you. All right, number 3, our core investment discipline. So there's two components here. One is our underlying principles about how we operate, and the second is our underwriting itself. So of course, I would hope everybody makes honesty, integrity, their foundation for their company, right? We do as well, of course. We do everything we can to align our goals with that of our investors. That's critical. Every term in our fund, everything we do has been done very deliberately to try to be as investor friendly as possible. And I think that's important. In terms of reporting and transparency, we do quarterly reporting with financials and rent roll and all of that. But what our investors like most is the narrative that we write up on each and every property to tell them exactly what's going on, exactly what we're doing, how's the renovation coming, what are we focused on, and so on, so that you have a full understanding what's going on with pictures and everything else. On the underwriting side, I said I have a financial background, right? CPA, lender, and I'm sure it comes as no surprise. I'm pretty conservative in terms of our underwriting. I underwrite from the bottom up. That's really important. We don't like to use book averages for anything. We know that just about every line item in a P&L can be proven out, and I have our people make sure that we do that when we're underwriting. Our experience allows us to do focused due diligence and focus on the things that matter, right? So many people I see spin their wheels on things that just don't matter. We're really focused on our due diligence and efficient with it, and sellers appreciate that. With every deal, we're trying to formulate multiple exit strategies because you just don't know what's going to come around the corner in terms of the environment, right? Who would have thought the pandemic would have been around the corner 2 years ago? And then lastly, and I won't spend too much time on this, but timely exiting a deal is really important in our business. I believe it is. So many people in this business like to build unit count. That has never been our goal. We will never make that our goal. They do that in part because they get to stack up a lot of fees then, right? I don't want to do that, right? We're here for you. And when it makes sense to exit that project, we've added our value, we've left some meat on the bone for the next guy or gal, then we're going to exit that deal. And that's part of the reason our returns are so high, because we're super careful about that. Number 4, execution. It's super critical. It doesn't matter how great a plan you have. If you can't execute, it doesn't matter. Our goal is two things. One, we're always reevaluating our business plan. You just have to do that because things are constantly changing. And our goal when we look at our plan and constantly revise it is to make sure we don't over improve and make sure we preserve our investor capital, right? That's another thing that we do that helps make sure our returns are good and better than most. We always renovate our deals from the outside in, right? Think of Jerry Maguire. You had me at hello. We use that model when we renovate, because we want to make sure that we grab people's emotions on the way in. And that way, when we get them inside the unit, we just don't have to let them down. And they're thrilled with what our product delivers. Let's see, we'll keep going here. Number 5, we're deeply entrenched in our target markets. I talked about this earlier. There's a lot of dots missing on this map here, but we're deeply entrenched in all of our markets. And that's really important to understand what you can do with rents, as well as getting the actual deals themselves. Lastly, I will say, I go back to this is the touchy-feely part of our business, right? I have a family, I have kids, just like you probably do. We understand why you invest, right? It's why we always put you first. It's why you're always going to have my cell phone number to talk to us, no matter what is on your mind, and we'll make sure that we always put you first in every decision that we make. So, a couple of things here, giveaways. Right below the booth, below the viewer, you will see links to my ebook, Multifamily Real Estate is a Total Game Changer. This is a short read, only 40 pages. But what it does 2 things. The first is attempts to answer that question that every single person has to answer before they get into real estate. And that is, they know there's a ton of money to be made. They're just not sure how to get their piece of it, right? So I take you through that decision-making process. Should you buy for yourself? Should you invest with a firm like ours? How should you do it? So I take you through that process and help you make that decision. Then, like most people, if you're like most people and choose to invest passively with a firm like ours, then I give you some insights into how our business works so that you can be prepared to vet sponsors. You can figure out how to detect things that maybe if you didn't understand how the business worked, you might not understand. And the last thing we're giving away here today, so do me a favor, make sure you download the book. I think it'll be a good read. I think hopefully you'll enjoy it. The last thing, we've never done this before, and this is for anybody that invests from the Money Show, that invests in our fund, we're giving you a $250 investor account credit. I've never done this in the 20 years I've done this. We were thrilled to be at the show here. We wanted to do something special, so we're doing that. Now, in addition to that, we're also having a drawing for 2 prizes. If you are one of the 2 people that win that prize, you will able to get $500 total investor account credit. So we're thrilled about that. Hopefully my presentation has given you a good feel for real estate and why you might want to invest in it. My question to you would be if you are ready to start building wealth with us. My contact information is at the bottom of the screen and all over our booth. Feel free to just reach out to me. After this presentation, I'm going to hang out in the Zoom room and love to answer your questions if we didn't get to them here on this webinar.
Ken, thank you very, very much. Folks, first of all, great presentation. We're getting a lot of questions. We have only a few minutes, so I'm going to try to get to a few of them here, but I would tell you, get with Ken if it's of interest to you. His email there, in case you can't see it, is kgee@kripartners.com. His website is kripartners.com, obviously. His phone number is 813-489-9666. Ken, I got a couple of questions, and then we've got a lot of questions, so people reach out to Ken directly and he'll be able to answer those for you. Ken, how do you guard against rising interest rates affecting cap rates and the resulting values when you are ready to sell?
Yeah, really good question. So remember the sensitivity analysis I did in my example? That is the #1 way that I model our underwriting. And we just do multiple iterations to figure out what if cap rates go up by 100 basis points, 200 basis points, and so on, so that we can figure out where the value is going to be. What's important in our underwriting is that we protect the downside, right? We never want to be in a situation where we're going to lose principal, and we know that the upside will take care of itself. So it's through that sensitivity analysis. And there's a lot of other things that come into play when you have a rising interest rate environment. I alluded to it when I pointed out our example, but when you have rising interest rates, the cost to own a home goes up as well, which actually allows us to move rents. I didn't illustrate that in our example. I don't usually illustrate it when I do our modeling because I want to paint a worst case scenario, but that's how we protect against it to make sure that we're still getting good returns, even if rates do go up.
Thank you very much. Next question comes from Marvin. Assuming, just give me 1 second, sorry. Marvin is asking you, assuming that the main risk is a crash in the dollar and or the economy, how did you guys do in 2008 during the downturn?
Yeah, so we managed and owned properties through that downturn, and there were a lot of things going on there. The people that ran into trouble during that downturn, they ended up having debt maturities or debt that matured at the wrong time, right? If you didn't have a debt maturity that hit at the wrong time, you were fine. Properties continued to cash flow. People did just fine. People that ran into trouble because they had to refinance their debt. The regulators made the banks get this real estate off their balance sheet. They also made the banks use tax returns instead of book numbers. And so everything looked like it was failing all of its covenants. So it then was really debt maturity. We've always managed our debt maturities to make sure we have lots of options so that we don't get through that process. So to very specifically answer your question, our properties did fine. We never had an investor call for capital during that period. And obviously we came out of it just fine. The properties that came out of it did well.
Thanks. And we're gonna ask one more, folks. Ken is going to be having a live Zoom right after this presentation. Once we end this Zoom, he's going to have his own Zoom in there. You can get in there and ask questions. There's been a lot of great questions. Unfortunately, we can't get to all of them. Here's a question that I guess a lot of people have been asking. A lot of people think real estate is pricey right now. Are you worried at all that you're getting in at or near the top?
Yeah, I would be worried if like back in 08, 07, 08, 09, if the banks were drinking the Kool-Aid and people were valuing properties for all the wrong reasons. That is not happening now. What's happening now are these real estate deals are trading based on fundamentals. The banks will not drink the Kool-Aid. They will not go below a 120 debt service or a 125 debt service ratio. They'll offer full term IO. We don't accept that because we don't like that. So as long as real estate continues to cash flow, there's not going to be a breakdown in terms of the value of the asset. Think about what I said about Florida, right? It's the reason we're in Florida. So during economic downturns, during crises, markets where people are leaving do poorly. Markets where people are moving to, which is Florida, has been Florida, probably will be for a very long time, they will continue to do fine. So as long as the cash flows, demand and supply continues to stack up the way it is, I don't feel it's pricey at all. If I felt like rents were maxed out and there was no way I could add value to a deal, then I would agree with you. But that's not what we're seeing. We're not seeing anything like that at all.
Okay, terrific. And Ken, thank you very much for your insights today. Folks, again, Ken's going to be doing a live webinar right after this, Zoom, I should say. So get with him after. There's been a lot of great questions. If you have them, he'll get granular with you either on the Zoom after this meeting or just contact him directly and he'd be happy to answer. But with that said, Ken, I want to thank you for all your insights and your opportunity of being with us today. And we want to thank all the participants in this obviously session and all the virtual sessions that we're doing here at Money Show. We really appreciate your support, your feedback and your comments, and keep them coming. It makes us better. So, and lastly, don't forget, folks, we're happy to be back live and in person. We'll be at the Omni Orlando Resort June 10th to 12th. It's our first time back since COVID started. We are excited to get back into a room and see you folks. We're firm believers that there is magic in these rooms when you get a bunch of people together. So come see us, get out, stretch your legs, and come meet some great people and get some great insightful information for your investing process. Ken, thanks again for your help and your time today. Folks, get with Ken afterwards, and we're going to see you at the next session. Thank you, everybody.